Good day, my name is Warren Gears. I'm the General Manager at the Johannesburg Stock Exchange. I represent the currency derivative markets. Today we're going to take you through why we trade currency futures, the benefits and the purposes thereof. My colleagues have done presentations in terms of getting started on the market as well as the initial and variation margins, so I will not be touching on that today. First of all, in 2007, the South African Reserve Bank gave dispensation to the South African market to trade currencies. This is a step in the direction in terms of allowing individuals and companies to take a view and to hedge any currency exposures or risks that they might have. Just very briefly, obviously the currency derivatives forms part of the Johannesburg Stock Exchange. We are a division of the stock exchange, and as highlighted on the slide, you'll see the currency derivatives market. So why trade currency futures? These are contracts that allow investors to trade on the exchange for some time in the future. Currency futures are an agreement between two parties. There's no counterparty risk between these relevant parties. The SAFCOM clearinghouse is the counterparty to every transaction that takes place on our market. Buyers and sellers come to the market to match their currencies where they have a view in opposite directions. In essence, we talk about longs and shorts in the exchange. Just to put this in simple terminology, as long as if somebody wants to buy a contract, having the view that the currency is going to move from 7 Rand to 7 Rand 50, purely as an example. Alternatively, you have somebody that wants to go short in the market. This means they want the currency to depreciate and therefore have a currency, in this case the Rand, move from 8 Rand to 7 Rand. What are the effective uses of currency futures? Firstly, it's an effective and transparent hedge. Everyone can see where the price is trading. So if you have a spot price, where people follow the TV, they follow the radio, they follow the press, everyone knows what the exchange rate is. They're always talking about the exchange rate, the dollar exchange rate. Well, in essence, you will be able to see this on the currency platform live at any which time in which we are trading. We diversify internationally. So if you have portfolios offshore, you're able to hedge out any risk or currency risk that you might have. If you've bought an asset overseas, you can hedge that asset and keep that asset's balance and value, so you never have to worry that it depreciates in value. You can take a view on the underlying market. Why we say this? We do get speculators in our market, and we encourage speculators. So what this is it allows me to take a view on whether the currency is going to move up or move down. In so choosing, I can make a profit, but more importantly, you can also make a loss. So we will advise you of risks in terms of trading in derivative products. You do not require any credit lines. If you are trading in the past, you traded an OTC product or over-the-counter products, you would have bought what we call a forward exchange contract. That is what we refer to as a forward or an OTC contract. In this market, you don't require credit lines. There, you would require credit lines. So if you bought an FEC, immediately your credit limits and your credit lines are impacted upon. Whereas in our market, you have no such worries. It is very cost effective. We say this, but obviously you need to take into consideration when you're trading a currency derivative, your price is made up from the party that you trade with. So if you're trading through a trading member, they will have their own cost structures. Our cost structures are very simple and very straightforward. We charge 1 Rand per 1,000 of the foreign underlying. So 1 Rand per $1,000. The rates are wholesale corporate rates. What this means is, in the past, if you went to a Rennie's Travel, for example, you would have been quoted rates with a spread of 7 Rand 30 to 7 Rand 80. They were very wide in terms of where you were priced at. Today, if you look at our pricing on screen, you'll see a price of 6 Rand 85, 6 Rand 86. You've got 1 cent spread, and this is what the corporates used to get benefits of in the market. You, as an individual or a corporate, will get this rate irrespective of what your balance sheet looks like. You have no counterparty risk. As I alluded to earlier, the clearinghouse is the counterparty. And the clearinghouse is made up of all the combined balance sheets of all the relevant banks in South Africa. So you have no risk in terms of who your counterparty is. Most importantly is you have deep liquidity in the underlying market. What are we referring to here? The dollar contracts trade $1.3 trillion a day in terms of value. So you never have to worry about getting in a transaction or out of a transaction. A market maker will always make you a price in our market, so you're never stuck with a position. I'd like to take just one slide in particular to run through what the comparisons is between something that's traded on the exchange and something that's traded off the exchange. In the slide that you'll see, one is called currency futures and one is called currency forwards. Currency futures are traded on exchange, currency forwards are traded off exchange. If we have a look, are both hedging instruments? Yes, indeed. Are they both derivative instruments? Yes, indeed. We know that many people have problems in terms of mandates saying I'm not allowed to trade derivatives. Well, if you're allowed to trade an FEC, you're trading a derivative, therefore you can trade on exchange too. Credit risk. Do you have credit risk trading a future? Not at all. As I said, the compound balance sheets are your counterparty. Do you have credit risk in terms of trading with your counterparty if it's through the OTC market? Most definitely. A lot of people will say, but my bank will never default. A lot of people said the same thing about Lehman Brothers, and look what happened there. Physical delivery. No, you cannot. We have a cash settled market, so basically you make your profits or your losses, and those monies are paid across or to or from you on a daily basis. Whereas on the physical delivery on the OTC market, yes, you can, and that's why you're trading that specific instrument. Okay, as alluded to earlier, we have deep liquid markets, so you never have to panic or fear about getting in or out of a derivative product. Are they standardized? In terms of exchange-traded products, we have standardized expiry dates, but in terms of the currency forwards, you can choose any date to trade. Are they cost-effective? Most definitely from an exchange point of view, but from a forwards point of view, it will depend on your credit risk. So if you're a AAA rated company, then you're going to get a better rating than me as an individual, and you need to bear that in mind. Gearing, most definitely, 22 times gearing or 4% of margin, and I'll go through those numbers a little bit later. You get no gearing on an FEC product. As I said, it impacts on your balance sheet immediately. Required credit lines, as I alluded to, definitely not, but if you're trading a forward, then most definitely so. So what are currency futures primarily used for? Obviously, the first and most important, which the exchange is promoting, is hedging. So any currency risk that you may have, you can lock in your profitability at day one without having any risk on your exposures. The second one, as I alluded to, is speculation. You can take a view on the market, whether it's going up or down, and make a profit, but again, as I say, I warn against, you can make a loss. So how are currency futures priced? I'm just going to go through it very quickly, and on the slide you'll notice that is called currency futures priced. Basically, it is the forward price that we trade on the exchange. We do not trade the spot price, so the price that you get quoted and you see and hear on TV, etc., is not the price at which you can transact at. That is what we call the spot price. On our market, we trade the futures. So the price is made up of the spot plus the forward points. Spot price, if we use an example of R6.85 as the bid, R6.88 is the offer price, we will add forward points to that. If we had an expiry date in November 2010, we would add 300 points onto the bid and 350 points onto the offer. Again, we have a bid-offer spread on the forwards. That will ultimately give you a future price of R6.88 or R6.91. Now what will happen is, obviously, if we're going to buy, we look at the offer price. So someone would sell it to us at R6.91. So in the example that we're going to go through, a company that imports goods from Europe, the UK, the US, wherever they might import from, they want to buy $100,000 worth of goods. They're going to buy it at R6.91. And if I go back to the previous slide, you'll see the price, the future price, the offer is R6.91. Very important when speaking to a broker at which price you're trading at. So in terms of the example, if I'm buying $100,000, I need to buy 100 contracts. The reason it's 100 contracts is because it's $100,000. Each contract's 1,000. Therefore, you need 100 contracts. In terms of what you will see on the screen behind me, which is the hedging example continued, this is a full cash flow of what will happen on a daily basis from the time you enter into a transaction to the time you exit a transaction. If we just go through day one as an example, on day one, as I alluded to, you buy at R6.9150. You have initial margin. As I said, this would have been covered in the previous topic. The initial margin is 320 Rand per $1,000. So to get to 32,000, we take 320 Rand, multiply by 100 contracts, because that's how many contracts you traded, multiply by 1,000 of the foreign underlying, giving you 32,000 Rand. This money sits with the exchange for the entire period while the contract and the position is open. This day, we have a mark-to-market closing price. This means, where does this transaction close at on a daily basis? Or where do we revalue on this day? In this specific example, it's closing at 7 Rand. So what happens is a profit that will flow in this instance. So if you had bought, you would have 8,500 Rand flowing into your account tonight. 7,000 Rand is made up by, or should I say the 8,500 Rand is made up by the 7, which is the closing price, subtracting the price at which you traded at, which was 6.9150 Rand, giving you 8,500. Your net cash flow for the day is 23,500. That will, as I said, but we do not offset your profits from your losses. We will sit the entire time with the 32,000 Rand in our account, but we'll also give you 8,500. On day 2, you do not trade, but we have another mark-to-market. We revalue the market at 7.05. This means another 5,000 Rand will flow into your account. Similarly, on month 3, and you will have another mark-to-market, and on month 4, you'll have a mark-to-market. But as you will see in the fourth column there, representing month 3, we are going to ask you to give us money tonight because we revalued at 6.95, so there was a loss of 10,000 Rand. This 10,000 Rand has to flow to the exchange on that night. Similarly, on month 4, we close the market at 7.1, so 15,000 Rand will flow into your account. This process will happen every single day until you close your position. The last day of expiry, we will close the position out irrespective if you have not asked us to roll it to the subsequent expiry month. And as you will see, your 32,000 Rand there in line 2, initial margin, is returned to you. This was your money. The loss or the profit for the whole period is 40,000 Rand. So from the time you enter into the contract till the time you exit, you would have made 40,000 Rand. This money is used to offset the loss in terms of which the direction of the currency, underlying currency, moved. So as you will see from the currency cash flow slide, your variation margin of 58,000 Rand, which is the total margin, which if you take them per the previous slide, if you add them all up together and subtract your losses, you will get to 58,500. This profit is offset from the spot movement, which moved from 6.88 Rand to 7.50 Rand. The difference between the 62,000 Rand and the 58,500 is 3,500 Rand. And you will notice you take that, the 350 forward points, multiplied by the number of contracts, gives you the same. So what did you pay to transact in this? You basically paid the forward points to a certain date in the future. What would have happened if the market had moved in the opposite direction to which you had envisaged? Well, basically, because you were long, hoping that the currency would remain where it was, and the currency actually weakened in terms of the dollar actually strengthened from 7 Rand towards 6 Rand. Well, what would happen is your physical payment in dollars would be lower, but you would have made a profit in the future, again offsetting each other. Which contracts do we trade? As you can see from the slide, we trade the dollar rand, euro rand, pound rand, Australian dollar rand, Japanese yen, Canadian dollar, Swiss franc, Chinese yuan, and the rand index. All are referenced against the rand. Because of Reserve Bank requirements in South Africa, we can only trade and settle against rand. We do not do currency pairs, although you can synthetically create one. So what are the benefits of trading currency futures? As I mentioned, you hedge against currency exposure. You always know the profit. You never have to gamble on where your profit or loss might be. You protect the value of your currency. You can speculate. You're trading on a regulated and efficient platform. The exchange it spends a lot of money every year to make sure our systems are adequate, and we make sure that client protection is first and foremost when we're trading in the derivative markets. We allow for transparent pricing. We're equalizing the playing field for all investors. As I alluded to earlier, whether you're a corporate or a retail, if you look at our screen, the prices that you get, the best prices that you will get around South Africa, if not the world. We allow individuals and smaller corporates to access favorable rates that used to be reserved for the large corporates. This is no longer the case. In terms of the slide that you see labeled risks, bear in mind, as I said, you can make money in terms of speculating, but beware, you can lose the same amount of money depending on which side of the fence you are sitting. If you look at our initial margin requirements slide, you will notice this is purely an example. Any value that you see here at the moment, for example, dollar rand 13 December, 320 Rand. That means for each 1,000 of the foreign underlying dollar, we're going to ask you to deposit 320 Rand with the exchange to trade $1,000. And this is where the gearing comes into it. The gearing is 22 times. Basically, we take $1,000, multiply by the exchange rate as of today, which we are sitting in November, it's about 7 Rand. So you're getting 7,000 Rands worth of exposure for 320 Rand. It's a good deal. Okay, so that really covers the very basic introduction and principles to currency trading. I will leave you with one last slide, which is really an advert from our side, and that is if the currencies push against you, you can push back. You won't get caught. Thank you.